right, get ready, because today we're going to really dig deep into this book, The Intelligent Investor.
Oh, yeah, this one.
This is by Benjamin Graham.
A classic.
Yeah, this is considered like the book if you want to learn about investing.
Of the Bible.
Yeah. And even though it was originally published way back in 1949, the ideas in this book are still super relevant today.
Absolutely.
We've got excerpts from the book itself, obviously. Yeah. We also have some commentary by Jason Zweig, who adds a more modern perspective.
Yeah.
And we've even got a section called The Super Investors of Graham and Doddsville.
Oh, cool.
Yeah.
I like that.
These are all the folks who've actually used these principles and, like, crushed the market.
Mm-hmm.
So think of this deep dive, like, as your cheat sheet.
I love it.
To understanding these strategies that can really make you a smarter investor.
Yeah, and what I think is really interesting is that Graham, he doesn't approach this book like it's some get-rich-quick scheme. Yeah. He really lays out like a philosophy, like a framework for how to think about investing.
Okay.
And it's really about the long game.
And he starts by talking about this idea of the intelligent investor.
Yeah.
But his definition might surprise you.
Maybe.
What exactly does he mean by intelligent when we're talking about investing?
So it's not about, having a super high IQ.
Oh.
Or like being a math whiz or something like that.
Okay.
He actually emphasizes that the intelligent investor is defined more by their character. Yeah. Than their intellect.
Interesting.
Yeah, in the book, he says intelligence in investing is a trait more of the character than of the brain.
Interesting.
So what he's talking about are things like patience, discipline, a genuine curiosity to learn, and maybe most importantly, like the ability to think for yourself and not just follow the crowd.
So like being able to stay calm and collected.
Yeah.
When like everyone else is freaking out.
Yes.
That's like a superpower.
Oh, yeah.
In the investing world.
Absolutely.
But how does that actually play out?
Okay, so think about it this way.
Okay.
Financial markets. They're constantly like bombarded by news, opinions, all these data points.
Yeah.
And it's easy to get swept up in all the hype.
Right.
And make decisions based on like fear or greed.
Yeah.
But an intelligent investor.
Okay.
Armed with patience, a commitment to lifelong learning.
Yes.
They can kind of see through all that noise.
Right.
They understand that true investing, it's about owning a piece of a business.
Right.
It's not just reacting to the ticker tape, every second of the day.
That's a really powerful distinction.
Right.
Owning a business versus just like trading stocks.
Yes.
And that kind of leads us right into another core concept.
Yeah.
That Graham hammers home.
Yeah, he's very clear about this.
Yeah, and that is the difference between investment and speculation.
Yes, absolutely.
So he defines an investment as something that you do after, like a thorough analysis, and with the goal of preserving your capital.
Right.
Meaning like not losing all your money.
Don't lose your shirt.
Yeah, and achieving a reasonable return.
Exactly.
Speculation, though.
Yeah.
That kind of tosses that safety net aside.
Tosses it right out.
Yeah.
Chasing those quick profits.
Yeah.
Often without, a very solid foundation.
So it's not that speculation is like inherently bad.
No.
It's just a totally different game.
Totally.
Right. Different risks and different rewards.
Absolutely.
And Graham actually uses some pretty vivid examples from his own experience to kind of drive this point home.
Yeah. He tells this wild story about making like a 250% return.
Wow.
In a single day.
Oh, my gosh.
Back in 1919.
Okay.
On this company called Savold Tire.
Savold Tire. Okay.
Yeah.
That sounds way too good to be true.
Well, a few months later, the whole thing crashed down. It turned out the company was a total fraud.
Oh, no.
And the stock became worthless.
Oh.
And Graham learned a very expensive lesson.
Right.
About the allure and the danger of speculation to really drive this point home.
Yeah.
He contrasts this with, much less thrilling scenario. Buying a really boring old telephone company bond at a 7.5% yield versus buying the Dow Jones Industrial Average, which was priced at 900 back then.
Okay, so like on the surface, most people would think the stocks are less risky.
Oh, yeah.
Right.
Totally.
Everybody knows about the Dow.
That's conventional wisdom.
Right, exactly.
Yeah. But Graham, always a contrarian thinker, he argued that at that particular moment, the stocks were actually riskier.
Really?
Yeah, they were priced so high that the potential for loss was actually greater than the bond.
Wow.
Which had this, steady, guaranteed return.
So it's all about, like, challenging your assumptions.
Absolutely. Right.
Yeah, and digging into the numbers.
Really digging into the numbers.
Before making any decisions.
Okay, that makes sense. Now, this kind of brings us to one of my favorite parts of the book, which is this brilliant allegory of Mr. Market.
Oh, I love this one.
I think this is something that every investor should understand.
Yeah.
Can you kind of walk us through it?
Imagine you own a share of a private company.
Okay.
Every day, this guy, Mr. Market, shows up at your door. He's your business partner, in a sense.
Right.
And he's always offering to buy your share from you or sell you more of his.
Okay. Sounds like a pretty good arrangement so far.
Yeah.
Well, what's the catch?
Well, Mr. Market is like the most emotional person you've ever met.
Uh-huh.
Yeah. Some days he's like euphoric.
Okay.
Totally convinced that the business is going to just explode.
Right.
And he offers you like a sky-high price for your share.
Okay.
But other days, he's totally doom and gloom.
Certain that everything's going to collapse. And he, like, practically begs you to sell your share at, like, a fire sale price.
Oh, wow.
Yeah.
So how does Mr. Market relate to the stock market itself?
The stock market is Mr. Market.
Okay.
Yeah. All those prices that we see every day are the reflection of, millions of investors, each with their own hopes and fears and biases.
Right.
And the key for the intelligent investor is to not get swept up in Mr. Market's wild mood swings.
Okay.
You can actually use his irrationality.
To your advantage.
To your advantage, yeah.
So does that mean that we should be buying when Mr. Market is depressed?
Wow.
And selling when he's manic?
It's more nuanced than that. It's definitely not just about trying to time the market perfectly.
Right.
Which, as Graham points out, is basically impossible to do consistently.
Yeah, for sure.
Yeah. He does provide a framework for how to navigate these fluctuations.
Okay.
But he also stresses that there's no, one-size-fits-all strategy.
Right. That's why he introduces these two types of investors, right?
It's that.
The defensive investor and the enterprising investor.
That's right.
Two different personalities, but both rooted in this, intelligent investor philosophy.
Exactly.
And I actually want to dig into those investor types a little bit more in a bit.
Yeah.
But before we do that, I want to ask you about this concept of margin of safety.
Okay.
That's something that's always really intrigued me.
Yeah.
Can you just explain what he means by that and why it's so important?
Okay. The margin of safety.
Yeah.
Absolutely essential to Graham's approach. Think of it as the buffer.
Okay.
Between what you pay for an investment and its true intrinsic value. So it's kind of like a built-in cushion that protects you from losses, especially when, the future is uncertain.
Okay.
And to explain this, he actually uses this brilliant analogy from the world of bridge engineering.
All right. I'm picturing hard hats and blueprints.
Right. So engineers, when they design a bridge, they don't just design it to handle the expected weight of cars and trucks.
Right.
Right. They build in a huge margin of safety, extra strength. To withstand extreme weather or earthquakes.
Right.
You name it. They're basically preparing for, the worst case scenario.
So Graham is basically saying that we should build that same kind of margin of safety into our investment decisions.
Exactly. And to show this in practice, he shares this really fantastic story from the 1920s.
Okay.
He was researching oil pipelines.
Okay.
And he was digging through all these really obscure reports.
Okay.
And he stumbled upon this company called Northern Pipeline Co.
Northern Pipeline Co.
Yeah. And they were trading for $65 a share.
Okay.
But get this.
Okay.
They were holding more than $80 per share in super high quality bonds.
Wait, so the stock was literally worth less than the cash and bonds they had on hand?
That's pure margin of safety.
Wow.
Yeah, so Graham bought the stock and no surprise.
You made a profit.
Yeah, he made a tidy profit.
Okay.
And this really illustrates how finding these undervalued opportunities, these situations with a huge margin of safety, that's key to successful investing.
That's a great story. But let's be honest, in today's market, where information is everywhere.
Yeah, it's everywhere.
Right. And everyone is looking for an edge. Finding those kind of deals seems almost impossible.
It's definitely more challenging than it was back in Graham's day.
Right.
But his principle of looking for that margin of safety is still incredibly relevant.
Right.
And one of the biggest mistakes I think that investors make is falling into the trap of chasing what's popular.
Right. The fear of missing out.
Yeah, exactly.
Yeah.
And actually, Graham has this whole chapter dedicated to the perils of popularity.
Oh, wow.
And I think it's one of the most important in the book, especially for today.
So what does he have to say about this, like fear of missing out?
Yeah.
This mentality that seems to drive so much investing behavior.
He's incredibly skeptical of blindly following the crowd.
Okay.
Especially when it comes to, like, investing in those, hottest sectors or the latest trends.
Right.
Yeah. And he explicitly warns that obvious prospects for physical growth in a business do not translate into obvious profits for investors.
Okay.
In other words, just because a company is growing like crazy doesn't mean the stock is a good investment.
So how do we know when that growth is actually translating into value?
That's the question.
Yeah, for shareholders.
That's where the real work of the intelligent investor comes in.
Right.
Yeah. We have to look beyond the headlines, beyond, like, the surface level excitement and dig into the fundamentals.
The fundamentals of the business.
Of the business, yeah. And luckily, he actually gives us a whole set of tools to do just that.
Okay, we're going to have to dig into those tools.
We will.
But before we get into that, I think it's important to actually circle back to those two investor types you mentioned earlier.
Right, yeah.
The defensive investor.
Yeah.
And the enterprising investor.
So he describes the defensive investor as someone who prioritizes simplicity, safety, and a moderate return.
Okay.
They're not looking to spend hours poring over, like, spreadsheets or trying to outsmart the market.
Right.
They want a reliable, steady approach to building wealth over time.
That sounds like, especially for someone who's new to investing or doesn't want to make it their full-time job.
Right.
That sounds like a really great starting point.
Yeah.
So what would be some typical investments for a defensive investor?
Their core portfolio would likely be a mix of low-cost index funds, which give you instant diversification across a broad market, and then high-quality bonds, which provide that steady income and reduce volatility. So this approach really minimizes the need for constant monitoring and active trading.
So the defensive investor is basically taking that long view.
Yes.
Right? Yeah. Letting their money grow steadily over time.
Yeah.
And not getting caught up in that day-to-day market trauma.
Exactly.
So what about the enterprising investor?
Okay. Well, the enterprising investor is,
more enterprising.
More enterprising.
Yeah.
They are comfortable putting in more time and effort.
Okay.
Digging into those financial statements, researching those individual companies.
Right.
And potentially taking on a little bit more risk.
Right.
For the potential of greater rewards.
So this sounds like where Graham's value investing principles really come into play.
You could say that.
Okay. So are enterprising investors essentially bargain hunting?
Yeah. They're looking for those hidden gems.
Okay.
The companies that the market has maybe overlooked or undervalued.
Right.
And this is where all those tools we mentioned become really important.
Okay. So now we're getting into like the nitty-gritty of Graham's approach.
The nuts and bolts.
Yeah, to actually picking stocks.
Yes.
But before we jump into that, I want to touch on one more concept that I think is critical for both defensive and enterprising investors.
Okay.
And that's the importance of understanding and managing our emotions.
This is huge.
Yeah, this is something that's not always talked about when you're talking about investing.
Right.
But Graham dedicates quite a bit of space to it in the book.
Absolutely. He understood that investing is as much about psychology as it is about finance.
Okay.
You know, human beings are wired to react emotionally to market fluctuations.
Right.
And these emotions can often lead us to, like, really costly mistakes.
Oh, yeah.
You know, when prices are going up, we get caught up in the euphoria.
The fear of missing out.
The fear of missing out.
Yeah.
Exactly. And when prices are plummeting, we panic. We sell at the worst possible time.
So what's the antidote to all of this?
So he provides a number of strategies. One of the most powerful is this thought experiment.
Okay.
Imagine you could only check your investment portfolio once a year.
Once a year.
Once a year.
That is a radical idea in today's world of like constant information.
Constant information, yeah.
Instant updates.
Instant updates.
Yeah, but just think about how that would change your perspective.
How would it change your behavior?
Yeah.
It would force you to focus on the long term.
Right.
To ignore all those, like, short-term blips in the market.
Right.
Make decisions based on like a deep understanding of the underlying business.
That's such a brilliant...
It's a good one.
Yeah, way to reframe our thinking.
Yeah.
It reminds us that investing is a marathon.
Absolutely.
Not a sprint.
Not a sprint.
And I think that's a perfect place to kind of pause for now.
Okay.
We've covered a lot of ground.
We have.
But there's still so much more to unpack in this book, The Intelligent Investor.
Oh, yeah. Tons.
Yeah.
Welcome back to our deep dive into The Intelligent Investor. I'm excited to pick up where we left off and explore some of Graham's more, hands-on strategies.
Oh, yeah. Last time we talked about those, crucial character traits for an intelligent investor. Patience, discipline, independent thinking.
Right.
And, of course, we can't forget Mr. Market.
Oh, Mr. Market, yeah.
That was a good one. But now let's roll up our sleeves.
Yeah.
And get into some of these nitty-gritty tactics.
Some nuts and bolts.
Yeah, that Graham lays out, especially for those enterprising investors.
Yeah.
Who are, like, ready to really dig into the world of stock picking.
Perfect. Yeah, let's start with one of the techniques that Graham mentions for finding undervalued companies.
Okay.
It's buying stocks for less than their net working capital.
Okay. Can you break that down for us?
Yeah. Sounds a little intimidating.
It might sound complex, but the concept is actually pretty straightforward.
Okay.
Net working capital.
Yeah.
Is essentially what's left over.
Okay.
After you subtract a company's short-term liabilities from its current assets.
Okay.
It gives you a sense of the company's, short-term financial health.
Right.
And Graham argues that if you can find a company whose stock is trading for less than its net working capital, you're essentially getting the company's fixed assets, things like property, plants, and equipment for free.
So it's like walking into a store and they're practically paying you to take their merchandise.
Exactly.
Wow.
That's a great analogy.
Yeah, it is a good one.
Of course, finding these kinds of opportunities, it takes a lot of digging, a lot of research. You have to really, go beyond the basic stock screeners.
Okay.
And dive into those financial statements.
Right.
But, that's what makes it exciting, right? Yeah, absolutely. It's like a treasure hunt for undervalued assets.
Yeah.
So what are some other tools or techniques that Graham recommends for finding those hidden gems?
So he also advocates for looking at low multiplier stocks.
Okay.
Which means companies with a low price-to-earnings ratio.
Yeah.
Now, a lot of investors get really fixated on that PE ratio.
Right.
But Graham cautions against using it in isolation.
Right.
It's just a one piece of the puzzle.
Right. It's tempting to just look for the lowest PE ratio and call it a day.
Yeah.
But as with everything, context is key.
Absolutely.
So how do we know if that low PE ratio actually indicates a bargain?
Right.
Or if it's like signaling something else entirely?
You have to look beyond the numbers.
Okay.
And really understand the company's business.
Okay.
Their industry, their growth prospects.
Right.
A low PE ratio.
Yeah.
Might be a sign that the market is undervaluing their future potential.
Okay.
But it could also be like a warning sign that something's, fundamentally wrong with the business.
Yeah.
That's why he really emphasizes going beyond, just the quantitative.
Right.
And developing a qualitative understanding
of the company.
Okay.
Of the company as well.
It's like those hidden non-recurring charges that Graham talks about in the book.
Oh, yeah. He uses this example of Micron Technology.
Okay.
Which, they had this habit of reporting these non-recurring charges.
Right.
Which are basically these one-time expenses.
Yeah, okay.
That companies often, they exclude from their earnings.
To make their profits look better.
To make things look better.
Right.
And they really are.
Yeah, it's like massaging the numbers a little bit.
Exactly.
Right.
But the thing is, in Micron's case, these supposed non-recurring charges kept recurring.
Oh.
Year after year.
Oh, wow.
So for Graham, this was a major red flag.
Right.
It signaled that they might be manipulating their earnings.
Right. Which could be a sign of deeper problems.
Within the business.
Within the business, yeah.
Yeah. That's a great reminder that we always have to be a little bit skeptical.
Absolutely.
Do our own digging, not just blindly trust what a company is reporting.
Yeah. Trust but verify.
Right. Exactly. Mm-hmm. Now, speaking of digging, Graham also talks about the importance of understanding financial statements.
Yeah.
Which, that can be kind of intimidating.
For a lot of people.
Yeah, for a lot of investors.
Yeah.
What's your advice for those of us who aren't, accountants,
right,
but want to get better at, reading and interpreting these documents?
Don't be intimidated.
Okay.
It's definitely a skill that takes time and practice.
Okay.
But it's absolutely essential for the enterprising investor.
Okay.
And Graham provides a lot of guidance in the book on how to approach them. Start with the basics.
Okay.
The balance sheet, the income statement,
Mm-hmm.
and the cash flow statement. Right. Focus on understanding what each statement tells you about the company's financial health, their operations, and
And don't be afraid to ask for help.
Oh, absolutely.
Yeah, there's so many resources available now.
Yeah.
Like online courses, investing communities.
Totally.
You can learn from other people who have more experience.
That's a great point. Investing doesn't have to be a solitary pursuit.
Right.
Learning from others, sharing knowledge can make it much more enjoyable and rewarding.
Okay. So we've talked about, some of the quantitative tools for evaluating a company, net working capital, price to earnings ratio, analyzing those financial statements.
Yeah.
But as you've emphasized, it's not just about crunching the numbers.
Right.
Graham also talks about the importance of understanding those qualitative aspects
Absolutely.
of a business.
Yeah.
So what are some things we should be looking at beyond just the financials?
So one of the most important things is understanding the management team.
Okay.
Right. You're investing in a business run by people.
Right.
And their competence, their integrity, their vision will ultimately determine the company's success or failure.
That makes total sense.
Yeah.
But how do we actually assess the quality of a management team? It's not like we could interview them before we buy stock.
Yeah. It's not always easy to get a really clear picture.
Yeah.
But Graham provides some really insightful questions to ask yourself when you're evaluating management.
Okay.
First, is the management team efficient?
Okay.
Meaning, are they effectively allocating capital and generating returns for shareholders?
Okay.
Second, are they looking out for the interests of, outside shareholders?
Right, because sometimes they're just looking out for themselves.
Or are they more concerned with enriching themselves at the expense of the company?
Right. Okay, so it's about assessing both their competence and their character.
Exactly.
And, this is where things like corporate scandals, like Enron, come to mind.
Oh, yeah. Enron, the perfect example of how a seemingly successful company can just be rotten to the core. Yeah. They use all these complex accounting maneuvers to hide their true financial condition, enrich themselves while totally misleading investors.
And this is why Graham emphasizes reading the proxy statement.
Yes. The proxy statement. Yeah.
That often overlooked document that provides all the details about
the company's governance, their executive compensation, and potential conflicts of interest.
It can really reveal so much about how a company is truly run.
Absolutely.
Yeah, the incentives driving, management's decisions.
Right.
And whether their interests are aligned with the shareholders.
Exactly.
So it's a great reminder that investing is an active process.
Not a passive one.
Very active.
Yeah. We have to be engaged.
Yes.
Informed and willing to ask those tough questions.
And sometimes that means walking away from an investment, even if it seems tempting on the surface.
Right.
If something doesn't feel right.
Okay.
Or if the management team is raising those red flags.
Okay. Now, so far, we've been focusing mainly on stocks.
Yeah.
Which makes sense. That's a major focus of, the intelligent investor.
What about the book? Yeah.
But I know Graham also talks about bonds.
Yes, he does.
Especially for those defensive investors out there.
Right.
So what are some of his key insights when it comes to bond investing?
So bonds are often seen as the, the less exciting cousin of stocks.
Yeah, for sure.
But they play a really crucial role.
Okay.
In a well-balanced portfolio.
Right.
Especially for those seeking stability and income.
Okay.
Graham reminds us that bonds can provide, a steady stream of income.
And act as a ballast.
Right.
During turbulent market conditions.
And they're less volatile.
Less volatile.
Than stocks, which can be really appealing for investors who, don't want to ride that roller coaster.
You don't want to be on the ride
of the stock market.
Yeah.
So what are some things that we should consider when we're choosing bonds?
So Graham talks about, a couple of key distinctions.
Okay.
One is the difference between taxable and tax-free bonds.
Okay.
Tax-free bonds, also known as municipal bonds,
Right.
are issued by, state and local governments.
Right.
And the interest income you earn from them is generally exempt from federal income tax.
Right. So it's not just about the yield.
Exactly.
It's about understanding that after-tax return.
The after-tax return, yeah.
Right. Which can vary.
Yeah, depends on your individual situation.
Okay.
He also goes into the question of, bonds maturities.
Okay.
The length of time until the bond's principal is repaid. Right. So longer-term bonds typically offer higher yields.
Okay.
But they also carry more interest rate risk.
Okay.
Meaning their prices are more sensitive to changes in interest rates.
Right.
Shorter-term bonds, on the other hand,
Yeah.
offer lower yields.
Okay.
But they provide more stability and predictability.
So choosing that right bond maturity really depends on your investment goals.
Exactly.
Right.
Yeah.
And your time horizon.
Yeah. If you need the money in the short term, locking it up in a long-term bond might not be the best strategy.
Right. Even if it offers a higher yield.
Got
it.
He also talks about a specific type of bond that was particularly popular in his time.
Yeah.
And that's the U.S. savings bond.
Okay.
These bonds are backed by the full faith and credit of the U.S. government.
Right.
So they offer, a high level of safety and a guaranteed return.
So those sound like a great option.
Yeah.
For that, sleep well at night portion of your portfolio.
Exactly.
Okay. That makes sense. Now, I know a lot of investors are tempted to try to time the market.
Oh, yeah.
Right? Buy low, sell high.
The holy grail.
Yeah. What does Graham have to say about this?
He's pretty skeptical.
Okay.
He argues that even, the most seasoned professionals have a terrible track record when it comes to consistently timing the market.
Yeah.
He even goes so far as to say that stock market timing is a practical and profitable activity only for a very small minority of investors.
Ouch. Okay. So if trying to predict the markets, every move is a fool's errand.
Yeah, it's good.
What's the alternative?
So he advocates for an approach that takes emotion and guesswork out of the equation.
Okay.
And that is dollar cost averaging.
Dollar cost averaging. Okay.
So this strategy involves investing a fixed amount of money at regular intervals, regardless of what the market is doing.
So instead of trying to pick that, perfect moment to buy.
Yeah, good luck with that.
Yeah, exactly.
Yeah.
You're just consistently investing.
Yep.
Over time. And it kind of averages out the price that you pay.
Exactly.
Okay.
And this approach has a number of benefits.
Okay.
First, it takes the emotion out of investing.
Right. You're not trying to outsmart the market.
Yeah. You're not trying to, predict the next big swing.
Right.
Second, it actually helps to reduce your average cost per share over the long term by buying consistently.
Yeah.
You're buying more shares when prices are low
Right.
and fewer shares when prices are high.
So it's almost like a built-in mechanism
Yeah.
to take advantage of market volatility without even trying.
You could say that. And this really gets to the heart of Graham's philosophy. Patience and discipline trump trying to time the market.
Every time.
Okay.
So instead of checking our portfolios obsessively,
Yes.
trying to catch every uptick and downtick.
Yeah, put the phone down.
Yeah, put the phone down. We should be focusing on the long game.
Absolutely.
The long game.
Building a diversified portfolio.
Yeah.
And letting time and compounding do their magic.
Exactly.
Now, I know we've talked a lot about staying rational.
Yeah.
Avoiding those, emotional decisions.
Right.
But investing can be an emotional experience.
It is.
Especially when it's our hard-earned money on the line.
It is.
So what are some practical tips for, managing those inevitable ups and downs?
Well, this is where Graham's emphasis on having a well-defined investment plan really comes into play.
Okay.
Your plan should outline your goals.
Okay.
Your risk tolerance.
Okay.
Your investment strategy.
And your criteria for buying and selling.
Right.
Having that roadmap in place can help you stay grounded.
Okay.
And make those decisions based on logic rather than fear or greed.
So it's like having a set of rules.
Yeah, like a rule book.
Yeah, that you stick to.
Yeah.
No matter what the market's doing.
No matter what.
And this helps to kind of prevent you from making like impulsive decisions.
Yeah, those emotional decisions.
Yeah, based on how you're feeling in the moment.
Exactly.
Okay.
He also talks about the importance of focusing on the long term.
Right.
Remind yourself why you're investing.
Okay.
What your goals are.
Yeah.
What your time horizon is.
Right.
The more you can zoom out and see that bigger picture, the less likely you are to get caught up in those short-term swings.
It's like that famous quote.
Yeah.
The stock market is a device for transferring money from the impatient to the patient.
I love that quote.
It's so true.
Mm-hmm.
And he also stresses the importance of diversifying your portfolio.
Absolutely.
We've touched on that a little bit.
Right.
Spreading your investments across different asset classes, industries, geographic regions.
All of it.
You're basically mitigating the risk.
Yeah, mitigate that risk.
That any single investment will make or break you.
Exactly.
So it's about not putting all your eggs in one basket.
Don't put all your eggs in one basket.
Right.
Yeah. Even if you're super confident in a particular company or sector.
Right.
And diversification isn't just about minimizing losses.
Okay.
Right.
Yeah.
It's also about maximizing your chances of capturing those unexpected gains.
Right.
We can't predict the future.
Right.
With perfect accuracy.
So having a diversified portfolio ensures that you're exposed to a wider range of opportunities.
Yeah, you're casting a wider net.
Yeah, exactly. He even highlights this this really fascinating study that Money Magazine did back in 2002. Oh. They identified the 30 best performing stocks.
Wow.
Over the previous 30 years.
Okay.
And the list was surprisingly diverse.
And it included companies from all sorts of industries, right?
Yeah.
Airlines to discount stores.
Wow.
To even a snuff tobacco maker.
Wow. Okay. So the point is, even with perfect hindsight, it would have been incredibly difficult.
Yeah. Good luck with that.
To pick out those winners in advance.
Yeah.
And that's where diversification comes in.
It comes in, yeah.
Right.
It acknowledges we can't predict the future.
Right.
Perfectly.
Right.
So we need to spread our bets.
Yeah.
And let the market do its thing.
Okay. Now let's circle back.
Okay.
To the distinction between the defensive investor and the enterprising investor.
Okay.
We've talked about, the characteristics of each type.
Right.
But how do those differences translate into actual investment strategies?
That's a great question.
Yeah, I think it would be helpful to hear some concrete examples of how those two types might approach building a portfolio.
So for the defensive investor, who prioritizes simplicity and safety, their core portfolio might consist mainly of low-cost index funds that track the broader market, like, the S&P 500.
Right.
They might also allocate a portion of their assets to high-quality bonds like U.S. Treasuries or investment-grade corporate bonds to provide stability and income.
So they're not trying to pick individual stocks.
Right.
Or time the market.
No.
They're just creating that diversified, low-maintenance portfolio.
Exactly.
That's designed to grow steadily.
Yeah, steady as she goes.
Steady as she goes, yeah.
Goals.
Over time.
Over time.
Okay, so what about the enterprising investor? What would their portfolio look like?
So the enterprising investor might take, a more active approach.
Okay.
They might still hold some index funds and bonds, but they'll also allocate, a portion of their portfolio to individual stocks that they've carefully researched and believed to be undervalued
by the market.
Okay. So they're doing more digging.
Right.
Looking for those hidden gems that offer the potential for higher returns.
Okay, so this is where all those techniques that we've been discussing come into play.
They come into play.
Right. Analyzing financial statements. Evaluating management teams. Looking for those, low multiplier stocks.
Right.
And seeking out those special situations.
Exactly.
Now, I know Graham dedicates a whole chapter.
Yeah, he does.
To the topic of the investor and market fluctuations. Which is something that every investor has to deal with.
Oh, yeah.
So what are some of his key insights on how to handle those, inevitable ups and downs?
So this is where his, understanding of psychology really shines. He recognizes that human beings are wired to react emotionally to those market swings, which often leads to, poor decision making. So he uses this brilliant analogy of the market as a manic depressive patient.
Okay, I love a good analogy. Tell me more.
He calls this patient Mr. Market.
Mr. Market.
And he's constantly swinging between extremes of euphoria and despair.
Oh, wow.
When he's manic, he's wildly optimistic, convinced that the good times will never end. And he's willing to pay like inflated prices for assets. But when he's depressed, he's, overcome with pessimism, convinced the world is ending. And he's willing to sell his assets for pennies on the dollar.
Well, okay, so Mr. Market is basically the embodiment of all those emotional swings.
Yes.
That drive market behavior.
Exactly.
Okay.
And the intelligent investor, according to Graham, doesn't get swept up in Mr. Market's wild mood swings. Instead, they use his irrationality to their advantage.
So they buy when he's fearful and sell when he's greedy.
Exactly.
That sounds simple enough in theory.
It does, doesn't it?
But I imagine it's incredibly difficult.
Oh, yeah.
To do in practice.
To put into practice, yeah.
Especially when everyone around you is like either panicking or,
Or getting caught up in the hype. Exactly.
Yeah.
It takes tremendous discipline and emotional control to stay grounded when, the market is going haywire.
Yeah, that's why having that well-defined investment plan is so crucial.
Essential.
It helps you to kind of detach.
Yeah, detach from the noise.
Yeah, from all that emotional noise.
Emotional noise.
Yeah. And make those decisions.
Yeah.
Based on your long-term goals.
Yeah, your long-term goals. And he also talks about the importance of understanding market history.
Okay.
Which can provide valuable perspective during those turbulent times. Yeah. He reminds us that market cycles are inevitable.
Okay.
Periods of euphoria are always followed by periods of despair and vice versa.
And he actually quotes the philosopher George Santayana, "Those who cannot remember the past are condemned to repeat it."
I love that quote.
So it's not just about
Welcome back to the final part of our deep dive into the intelligent investor.
I feel like we've been on this incredible journey.
Yeah.
Through the world of intelligent investing.
It's been a ride.
It has. We've talked about those, essential character traits. The difference between investment and speculation. The importance of understanding financial statements.
Yes.
The role of market psychology.
All the big stuff.
All the big stuff. So much more.
So much more, yeah.
But there's this one concept, I think, that deserves special attention.
Okay.
One that Graham considers to be the cornerstone of his whole philosophy.
The most important thing.
Yeah, and that's the margin of safety.
Margin of safety, yes.
We've touched on it. Throughout this deep dive.
We've talked about it a little bit, yeah.
Yeah, but I think it's worth really unpacking it now.
Okay, yeah.
Here in the final part.
Let's do it.
So why is this concept so crucial to Graham's approach?
Well, he actually goes so far as to say that if he had to distill the secret of sound investment into just 3 words, it would be margin of safety.
Margin of safety.
Margin of safety. It's the buffer between the price you pay for an investment and its intrinsic value. That cushion that protects you from losses, especially when the future is uncertain.
So finding those situations where the market price is significantly lower than our estimate of the company's intrinsic value is key to minimizing risk.
Absolutely. It's like, buying something on sale. But instead of a sweater or a pair of shoes, you're buying a piece of a business.
Right. Okay.
And Graham, he provides a fascinating historical perspective on this margin of safety idea. He points out that during his, early years on Wall Street, back in the 1920s and 1930s, it was relatively easy to find stocks trading at a significant discount to their intrinsic value.
Those were the golden days.
Those were the days.
For value investors. But I imagine as more investors kind of caught on to Graham's principles, those bargain opportunities.
They became a little less frequent.
Yeah, they dried up a bit.
They dried up. He even writes, the margin of safety is always dependent on the price paid. It will be large at one price, small at another, and non-existent at some higher figure.
So the margin of safety is not like static.
Right.
It's dynamic.
It changes.
Yeah, it changes as market conditions change and as the fundamentals of the business evolve.
Exactly. And this means we need to constantly reassess that margin of safety.
Of our holdings.
Of our holdings, yeah. We can't just assume because it was undervalued a year ago.
Right.
It's still undervalued today.
Right, exactly. So ongoing research and monitoring are essential.
Essential, yeah.
Even for those, long-term buy and hold investors.
Absolutely.
You can't just set it and forget it.
You're going to stay on top of it.
Yeah.
Now, in addition to, the core chapters, the Intelligent Investor also includes several appendices that provide further insights into Graham's philosophy.
Okay.
And they offer, valuable case studies.
Okay.
One of my favorite appendices is actually titled The Super Investors of Graham and Doddsville.
Oh, yeah. Have you had a chance to read this one?
I have. It's a great one.
It's so inspiring to read about these investors who've achieved incredible success by applying these principles.
It's amazing.
It really kind of reinforces that this approach is not just theory. It can actually work.
Yeah, it works in the real world.
In the real world.
And these investors, they come from such diverse backgrounds, but they all share a common approach that focus on value, seeking out that margin of safety, and remaining patient and disciplined through those market cycles.
And the results speak for themselves.
They do.
They consistently outperformed the market. Generated, substantial wealth.
A lot of wealth.
Yeah, for themselves and their clients.
It really highlights that intelligent investing, it's not about luck. It's not about market timing.
It's about having a sound philosophy.
Yeah.
A disciplined process.
Yeah.
And a commitment to continuous learning and growth as an investor.
You got it.
Now, as we wrap up this deep dive, I think it's important to acknowledge that The Intelligent Investor can be a challenging read.
It can be.
It's dense. It's detailed.
Yeah, it's not a quick read.
It requires, a certain level of commitment to really grasp the concepts.
To get through it, yeah.
Yeah. But I think it's one of the most rewarding books an investor can read.
I agree completely. It's a book that you can return to again and again.
Oh, yeah.
Throughout your investing journey.
Yeah.
And each time you'll find new insights.
Right.
New perspectives that can really help you become a more informed and successful investor.
So if you're serious about building wealth through investing, I highly recommend picking up a copy of The Intelligent Investor and just diving in.
It's a classic for a reason.
It is. It's a book that can truly change your financial life.
And as Graham would say, the intelligent investor is a realist who sells to optimists and buys from pessimists.
So stay grounded.
Stay grounded.
Stay disciplined.
Stay disciplined.
Stay curious.
Stay curious.
And remember, investing is a marathon, not a sprint.
It's a marathon.
Thanks for joining us.
Thanks for having me.
On this deep dive into The Intelligent Investor.